Welcome to the deep dive. We're here to cut through the noise on complex topics.
And today we're tackling something central to anyone thinking about putting their money to work, investing.
Right. It can feel, well, overwhelming sometimes. All the strategies, the warnings about risk. Where do you even start?
Exactly. So our goal today is to demystify some of that. We're focusing on investment strategy and risk management.
And we're grounding this in a real world example, right?
We're using the prospectus as the official detailed document for a specific fund, the 3032 serum.
Okay, a prospectus. Sounds a bit heavy, maybe.
It can be, they're very detailed, but they contain the absolute core information, the nuts and bolts of how a fund plans to operate.
So think of this as a shortcut. We're pulling out the key ideas on strategy and risk from this document.
And making them understandable, actionable for you, no matter how much experience you have.
Our mission, then, is to use this fund's playbook to understand the fundamental approaches to investment strategy and risk management.
So you walk away with a clearer perspective on these really vital concepts. We're not recommending this fund, just using it as a case study.
Got it. So let's dive right in. Investment strategy. What's the big picture goal for a fund like this one?
Well, the prospectus states it quite clearly. They have two main objectives that work together.
Okay.
First, shisus, with osisus. Basically, they're striving for long-term, stable growth of the money in the fund.
Long-term stable growth. Sounds good. What's the second part?
The second is just as important. Ishun, controlling risk.
Ah, the balance. Growth, but keep the risks in check.
Exactly. It's fundamental. You're always weighing potential returns against potential downsides. It's not growth at any cost.
That makes total sense. So how do they actually try to achieve that balance? What tools are in their toolkit? What can they invest in?
The prospectus lists out their investment scope, and it's pretty broad.
Like what?
All sorts of bonds, government, financial institutions, corporate bonds, even convertible and exchangeable ones, which have some stock-like features.
Okay, bonds are a big part then.
Definitely. But also stocks, main market boards, Chinext, and stocks available through the Hong Kong Stock Connect.
So domestic and some international equity exposure too?
Right. And then there's more. Asset-backed securities, bond repos, CDs, bank deposits, money market stuff, even treasury bond futures.
Wow, that is a wide playing field. Lots of options.
Yeah.
How do they decide the mix? Surely they don't just randomly pick from that list.
No, absolutely not. That's where the specific percentage allocations come in. These are really key to understanding their strategy and risk profile.
Okay, give us the highlights.
It's the big one. At least 80% of the fund's assets must be in bonds.
80%. Okay, that clearly signals a focus on fixed income, on stability.
Precisely. Then on the flip side, the combined total of stocks and those convertible or exchangeable bonds can't be more than 20% of the assets.
So a smaller slice dedicated to potentially higher growth, but also higher risk assets.
Correct. And within that stock slice, the Hong Kong stocks via Stock Connect are capped at 50% of the stock allocation, not 50% of the whole fund.
Ah, okay. A specific limit within a limit. Any other key numbers?
Yes, they also need to keep at least 5% of their net assets in cash or very short-term government bonds. That's after accounting for margin needed for futures trading.
So that 80% in bonds shouts stability. The 20% cap on stocks allows for some growth potential, but keeps it contained.
Exactly. And the Hong Kong limit suggests a focused approach there. That 5% cash is like a liquidity buffer, right?
Yeah, ready cash for payouts or maybe opportunities. These percentages really paint a picture of the fund's risk appetite. Lower volatility seems to be the aim.
It aligns perfectly with their stated goals. Stable appreciation, controlled risk. The equity part is there to potentially add a bit extra over time.
So within those big buckets, the 80% bonds, the 20% stocks, convertibles, how do they actually pick the specific investments? What strategies are they using?
They outline several core strategies. First up is the overall asset allocation strategy.
Okay.
They describe this as top-down, so they start with the big picture.
Like looking at the whole economy.
Yeah, exactly. Macroeconomic trends, growth, inflation, policy decisions, market sentiment. Based on that broad view, they decide the general mix between bonds, stocks, and cash at any given time.
So they're surveying the landscape first before deciding where to put their resources. Makes sense.
Then, within that huge bond allocation, they have a detailed bond market investment strategy.
More than just buying any bond, I assume.
Oh, much more. They're analyzing key factors for each potential bond. Credit risk is a huge one. Will the issuer pay back?
Crucial for bonds.
And liquidity risk. How easily can they sell it if needed? plus profitability potential, and, importantly, the risk-adjusted return. Are they getting paid enough for the risk they're taking?
How do they figure out that credit risk? That seems vital.
They have a specific credit bond investment strategy. They really dig into the issuer's health,
What do they look at?
industry outlook,
Hmm.
the company's market position, its financials, management quality, debt levels, the whole picture.
And they have standards, like minimum quality.
Yes, strict standards. Generally, they aim for bonds rated AA+ or higher,
Okay.
and at least half their bond holdings must be AAA or equivalent. The AA+ portion can't exceed 50% either.
So a strong bias towards higher quality debt. What if a bond gets downgraded after they buy it?
Good question. If the rating drops below their minimum, they have to adjust the holding, usually meaning sell it within 3 months.
That's disciplined. Shows they're actively managing that credit risk. What other bond tactics do they use?
Several sub-strategies. There's an interest rate bond investment strategy. This focuses on predicting interest rate movements and managing the portfolio's duration.
Duration. That's sensitivity to rate changes, right?
Basically, yes.
Yeah.
If they think rates are going up, which hurts bond prices, they might shorten the duration to lessen the impact.
So actively managing interest rate risk, you mentioned timing strategies too.
Briefly, yeah. Things like riding the yield curve, trying to benefit from the typical shape of yields over time. Also, interest rate spread strategies using the repo market and yield spread strategies looking for relative value.
Relative value, like finding bonds that seem mispriced compared to similar ones.
Exactly. Looking for those small inefficiencies or temporary discrepancies in yield.
Sounds like quite active management within the bond space. What about those convertibles and exchangeables?
They have specific strategies for those two, given their hybrid nature, part bond, part potential stock.
Right.
For convertible bond investment, they focus on issues where the underlying company has strong fundamentals and good growth prospects for its stock.
Trying to capture that equity upside. And exchangeables.
Similar idea, but these convert into shares of a different company held by the issuer. Strategies might involve IPOs, secondary market plays, or even arbitrage around the bond's options or terms.
Interesting. So again, looking for that equity kicker, but with some bond downside protection. Okay, let's shift to the smaller slice stocks. What's the approach there?
For the stock investment strategy, they use a bottom-up approach.
The opposite of the top-down for asset allocation.
Exactly. Here, they're not starting macro. They're doing deep dive research on individual companies.
So less the tech sector looks good, and more, let's analyze company X's business model and financials.
Precisely. Their individual stock selection strategy combines qualitative and quantitative analysis.
Okay, break that down. Qualitative first.
That's looking at the business fundamentals. Does it have strong growth potential? What are its core competitive advantages? Tech, brand, market position. Is its profitability sustainable? Is the management good with a clear strategy?
So understanding the story, the quality of the business, what about the quantitative side, the numbers?
That's where valuation comes in. They use relative valuation comparing metrics like PE, BB, PEG ratios against peers,
Okay.
and absolute valuation methods like discounted cash flow, DCF, or dividend discount models, DDM, trying to estimate an intrinsic value based on future earnings or dividends.
Trying to figure out what the stock is really worth.
Essentially, yes. And assessing if the current price is reasonable. They also look hard at growth metrics, sales, profit growth, and profitability indicators like asset quality and financial structure.
Wow, that's thorough. Both the business quality and the hard numbers. What about the Hong Kong stocks specifically? Any unique angle there?
Their Hong Kong stock investment strategy focuses on companies with solid fundamentals, valuations that look reasonable compared to mainland A shares.
Okay. Looking for relative value, perhaps?
Could be. And companies with sustainable competitive advantages, plus a focus on paying cash dividends.
So quality, potential value, and income, and those depository receipts.
The strategy there mirrors their overall stock approach, analyzing the underlying foreign company and investing if the value proposition looks good based on their research.
Got it. Now, the prospectus mentioned a leverage strategy. Leverage can sound scary. How are they using it?
They explain it mainly involves using repurchase agreements or repos. It's a way to borrow short-term, usually at low rates, by temporarily selling bonds they own.
And they use the borrowed cash, too.
Invest in potentially higher-yielding bonds. The aim is to earn more on the new bonds than the cost of borrowing. But crucially, they state they will strictly manage credit and liquidity risks associated with this.
So it's Calculated, controlled leverage to potentially boost returns, not wild speculation. What about the Treasury bond futures strategy? Futures also sound complex.
They stress the primary use is hedging.
Hedging, like insurance.
Sort of.
Yeah.
Using futures contracts to offset potential losses in their main bond portfolio due to broad market moves like interest rate shifts. It's about managing systemic risk and liquidity.
So risk reduction, not just betting on futures prices.
That's the stated goal, yes. And they have to follow regulations.
Okay. Lastly, asset-backed securities, things backed by mortgages or other loans. What's the strategy?
Detailed analysis of the underlying assets is key. They look at macro factors, the industry health, the structure of the asset pool, expected prepayment and default rates. They're trying to forecast the cash flows.
Lots of analysis there.
And they analyze the issuance terms, liquidity, and again, strict credit risk control is emphasized.
It really sounds like a comprehensive, layered approach across all these different asset types, always coming back to that balance of seeking returns while managing risk.
Absolutely. And that risk management piece isn't just an afterthought. It's built into the structure, which brings us neatly to the next critical area.
Right, the investment restrictions. These are the hard rules designed to keep risk in check.
Exactly. They act as guardrails.
Huh.
We already mentioned some key ones: the 80% minimum in bonds, the 20% maximum in stocks and convertibles, the 5% minimum cash. Those are fundamental portfolio limits.
Just setting the overall risk level. What else?
They have single issuer limits.
Hang on.
Can't put more than 10% of the fund's value into securities from just one company, and that combines A shares and H shares if applicable.
Diversification, basically. Don't put all your eggs in one basket.
Precisely. And there are broader limits, too, looking at holdings across all the funds managed by the same company, UTON, to limit their overall influence on a single stock.
Makes sense. What about those asset-backed securities? Specific rules there.
Yes, several. No more than 10% of the fund in ABS from a single originator. Total ABS capped at 20% of the fund. Limits on how much of a single ABS issue they can own.
Layered limits again?
And that minimum AA plus credit rating for ABS with the rule to sell within 3 months if it drops below reinforces the quality focus.
Okay. What about riskier activities like IPOs, futures, controls there?
Definitely. For IPOs, limits on application size relative to fund assets in the IPO size. For Treasury futures, clear limits on the value of contracts they can hold, both long and short, tied to the fund's NAV and bond holdings. It prevents excessive speculation or leverage through futures.
So, tight controls around potentially volatile areas. Are there any overall limits, like total borrowing?
Yes, the fund's total assets can't exceed 140% of its net assets. That directly caps the overall leverage.
Like 140%.
There are also limits on investing in illiquid assets. Things hard to sell quickly can't hold more than 15% of the fund's value in those.
That 15% illiquid limit seems important for meeting redemptions, right? Making sure they can pay out investors who want their money back.
It is. It helps manage liquidity risk. And speaking of risks, the prospectus also lists broader categories investors should know about.
Beyond the specific investment limits.
Right. They mention systemic risks, big picture stuff like economic downturns, political events, also non-systemic risks, specific to one company failing, for instance.
Standard investment risks.
Yes. Plus liquidity risk, the risk of large outflows, forcing asset sales at bad prices. Operational risks in managing the fund. Credit risk of the underlying investments.
They seem to be covering all the bases. Any risks unique to this fund's strategy?
They do highlight some. Risks tied to Hong Kong Stock Connect, investing different trading rules, currency risk, risks with depository receipts volatility, issues with foreign companies, and critically for this fund, the liquidity risk tied to that 30-day minimum holding period. You can't just cash out instantly.
That's a big one for investors to note. Ties up your money for at least 30 days per share.
Definitely. They also mentioned the risk of the NAV falling below the initial 1.0000 RMB price, and potential risks from investing in newer boards like the Science and Technology Innovation Board.
Anything else unique?
They mentioned the side pocket mechanism.
Side pocket?
Yeah, it's a tool they could use if they hold illiquid assets during a period of large redemptions. They could potentially separate those hard-to-sell assets into a side pocket.
And what does that mean for investors redeeming?
It could mean they get paid out in stages, receiving value from the main portfolio first, and then later from the side pocket if and when those assets are sold. It's meant to be fair to both leaving and remaining investors.
Interesting mechanism for difficult situations.
It is. And finally, the standard but crucial disclaimer. Past performance doesn't predict the future, and the manager doesn't guarantee profits or principal. Investing always involves risk.
Absolutely essential to remember. Okay, let's try to wrap this up. What are the big takeaways from this deep dive into the fund's strategy and risk management?
Well, I think it shows a really multi-layered approach. You've got that top-down view guiding the big asset splits, combined with intensive bottom-up research for picking individual bonds and stocks.
A clear bias towards high-quality bonds for stability, with a measured allocation to equities for growth.
Right. And rigorous analysis underpinning both bond and stock selection. Credit quality, fundamentals, valuation.
And all of this happens within a very defined set of risk, controls the allocation limits, diversification rules, credit standards, leverage caps, limits on complex instruments.
Exactly. The strategy and the risk management are deeply intertwined. Understanding both gives you, the listener, real insight into how this kind of fund operates.
It helps you assess if its approach aligns with your own goals and comfort level with risk, doesn't it?
Absolutely. It moves beyond just looking at past returns.
So thinking about everything we've discussed, this detailed approach to active management, the specific risk controls, it leads to a question for you listening.
How might you take these principles thinking about asset allocation, security selection, diversification, risk limits, and apply them to your own financial planning or how you evaluate any investment?
Or perhaps, armed with this understanding, what key questions should you now be asking when you look at different investment opportunities? Something to think about.
Definitely food for thought. The world of investment keeps changing, but these core principles remain vital.
Indeed. Thanks for joining us on this deep dive today. We hope it sheds some light on the complex but crucial areas of investment strategy and risk management.